Hello everyone and welcome back to another video. In today's video, we have a lot to discuss. Bill Ackman recently did an interview, and in it, he discussed what he believes makes a fantastic business. Also, the Buffett indicator is now saying that the stock market is incredibly overvalued, so we gotta discuss that. Nvidia's CEO also announced that quantum computing is getting closer, which is now causing quantum stocks to absolutely skyrocket. Westinghouse announced that it is in discussions to build 10 nuclear reactors across the United States. Airbnb finally announced its great summer launch. And then lastly, I want to discuss a stock that I just completely sold out of, and why I did so. I think that it will provide a great lesson for all of us as investors. So with that being said, let's dive right into the video, and let's start off by taking a look at what Bill Ackman said about what makes a fantastic business.
So you like what you call super durable companies. Define
Yes.
what you see as super durable.
Well, the value of a financial asset is the present value of the cash it generates over its life. How can you build a DCF model unless you can predict those cash flows? So the business has to endure. And we try to find things we never need to sell, and we try to find businesses that can grow forever. There aren't that many of them. So that's why we own such few companies.
Say you only get one good idea a year.
One or two, if we're lucky, yes. But that's enough.
And find your royalty concept.
So the best business, I believe, is one that doesn't have to invest capital, but earns a perpetuity growth annuity. Right? Asset management's a great business if you can invest the assets well and you can get paid a fee, off a base of assets of other people's money. But there are other businesses that meet that model. So Tim Hortons is a franchise restaurateur. They have a brand, they have a system, and then the franchisees put up the capital, and they get a royalty on every, coffee and donuts that's sold at Tim Hortons. Universal Music is a royalty on people listening to music. Hilton is a royalty on people staying in hotels. They own a brand. Other people put up the capital. So most of the companies we invest in can be thought of as annuities or growth royalties. And the key is it's predicting which of these royalties will endure. And that's a more complicated question.
When you think of a company like Uber, you don't think of an annuity, or Amazon an annuity. But
I think Uber is precisely that, right? They don't pay for the cars, and they don't do the driving, right? They have a system. They've got a platform. They've got a user interface. And they aggregate all that demand, and then they get a royalty. Let's call it 20% of the ride in exchange for delivering the demand. That's an amazing business. Again, if you can have confidence that the Uber platform will be the platform a decade from now and 2 decades from now.
So you've made the point, these are things that aren't easy to replicate.
Yes.
No one's going to reinvent Amazon anytime soon.
That's right.
And sometimes you don't buy what cheap. You think it's a good value, but it doesn't look cheap. Chipotle.
Yeah, so Chipotle didn't look cheap. People use kind of a rubric for valuing businesses, right? The PE ratio is kind of a very simple way to think about a business, but a stock can be expensive at 10 times earnings, and it can be cheap at 50 times earnings. What matters is not next year's earnings. What matters is the present value of the cash over the life of the business. At the time we bought Chipotle, they had a food safety crisis. Sales were getting crushed. People thought the company was going out of business, and it didn't look cheap. But if you believed you could change the course of Chipotle's history, fix the food safety issues, it was extremely cheap. And the stock is up, probably ninefold from the time we bought it.
In this video, Bill Ackman said that he is looking for businesses where he believes that he will never have to sell them. And the types of business that he wants to own are the ones that he believes where he can predict the future cash flow of the business. So if a business is unpredictable to him, then it's not one that he wants to build a position in. And if you've taken a look at the Pershing Square portfolio, it is a pretty concentrated portfolio, especially for a large hedge fund manager. And part of the reason Bill Ackman's portfolio is so concentrated is because he believes that there is not a lot of businesses that he believes will grow forever and can do so with any sort of predictability. He then said that the best type of business is one that does not need to continue reinvesting a large portion of its profits to continue growing the business and its cash flows. This is actually what Warren Buffett has said previously before as well. And Ackman used Uber as an example of a company that has this royalty type of cash flows and business, because Uber doesn't own the vehicles and all they do is provide the software for people to get a ride on or deliver some food. So this is the type of company that doesn't need to continue acquiring or buying more vehicles to expand its fleet to grow the business. All it needs to do is continue growing its network and making its network more desirable for people to join, download the app, and become drivers on. That's how Uber's business grows, is they get more people onto their software, onto their service, and then all they do is connect the passenger to the driver. And as long as they can continue connecting more passengers and drivers, then they can continue to grow their business and their profits. This does not take a lot of capital for Uber to do. And that's how they earn a royalty on the ride-hailing industry. Now, the next point that I found very interesting in this interview is Bill Ackman says that a stock at 10 times earnings can be expensive and a stock at 50 times earnings can be cheap. And I completely agree. And I was actually asked about this recently in my Patreon community, and someone asked me, Daniel, what is the price multiple where a stock starts to look cheap and like a buy? And in this person's question, they said, for example, is 15 times earnings cheap? And does that mean that the stock is a buy? Unfortunately, investing is just not this easy. And one stock at 15 times earnings can look expensive, and one stock at 15 times earnings can look cheap. Now, I try to boil my entire investment process down to your going in price that you pay for the business and your future growth expectations from that business. It's quite literally a value growth calculation. Now, there's a lot of things that go into this value growth calculation, like the management. Are they trustworthy? Does the business have a moat? What is its historical track record? Has management beat guidance? Have they raised guidance? Have they missed guidance? What does the business do? What are its competitors? So there's a lot of inputs that go into this equation, but I try to boil the entire investment process down into my going in price and what I think the future growth of the business is going to be. That, I think, is what Bill Ackman and Warren Buffett also do when you listen to their interviews. So for example, one business could be trading for 15 times earnings, but if its earnings are declining by 30% per year, then that's not an attractive price at all. Because if the earnings are declining, then it means that your going in price to earnings ratio will go up as the profits decline, which ultimately makes that business look expensive. Now, on the other side, if a business is selling for 15 times earnings and it's growing at 30% per year consistently, then that looks like a freaking steal, because within just the next few years, your price to earnings ratio on cost is going to go down to 7, 3, 1, and continue going down as the business grows. We could even make this example more extreme, where if a business is trading for 30 times earnings, but it's maintaining that 30% growth rate, and I believe that it could continue to do so over the next decade, then that could still look like a cheap stock. So you cannot boil investing and the valuation process down to just simply looking at what is the price multiple of a business. That does not give you nearly enough context to make a decision on whether the stock looks cheap or expensive. And again, two businesses selling for the exact same price multiple can be completely differently valued, and one could look expensive and one could look like an absolute steal. Bill Ackman actually uses his Chipotle investment as an example of this. And Bill Ackman was buying Chipotle all the way back in 2016. And if we head over to Chipotle's net income here, we can see that in 2015, it produced about $530 million in earnings. And by the end of 2016, it was only doing about $23 million in earnings. So Chipotle's earnings fell off an absolute cliff and dropped by something like 95%. And here we can see that during this time, Chipotle had a price to earnings ratio of 530. So Bill Ackman was buying Chipotle when its price to earnings ratio was over 500, but he said that he believed the business was looking cheap. And the reason was because he believed that Chipotle's earnings would recover as the business got through the downturn that they were currently experiencing. And as we can see, Chipotle's earnings are now $1.56 billion. And if we also take a look at the price to earnings ratio on cost, then we can see here that when Bill Ackman was buying Chipotle shares in 2016, he got them at a price to earnings ratio on cost now of about 8. So in hindsight, we can see that this was a good buy for Bill Ackman, even though the price to earnings ratio was over 500 when he was loading into the stock, because the company's earnings expanded so dramatically over the following 9 years that his price to earnings ratio on cost lowered all the way down to 7.8. And in hindsight, once again, that looks like an absolute steal of a price. So just because a stock may have a high multiple of its earnings or cash flows today does not mean that it is immediately an expensive business and cannot offer great returns going forward. You have to dig deeper into the investment and into the business, better understand it, and also understand if its profits are going to continue to grow at rapid rates over the long term, and ask yourself how confident you are in that happening. Because if a business can scale its profits dramatically over the following decade, then a high multiple today may not look that expensive in reality. But now let's move on and talk about the Buffett indicator, because I'm sure that some of you have been seeing the same posts that I have been seeing on social media, saying that the Buffett indicator is indicating that the US stock market is massively overvalued and we should all be running in fear right now. So I saw this post on X a couple of days ago and I took a screenshot and I want to share it here. So this says, "Ladies and gentlemen, I present to you 200%. Thanks for listening. The Buffett indicator is saying that the US markets are significantly overvalued." Now, before we move on, I should explain what the Buffett indicator is. So all the way back in about 2000, Buffett was referencing what he claimed was the Buffett indicator, which is simply the market valuation or the valuation of the US stock market divided by the US GDP. And when the value of the US stock market was equal to the US GDP or above the US GDP, Buffett would say that the US stock market was fully priced. And if the value of the US stock market got well above the GDP of the United States, then he would say that the market was looking overvalued. And this website that I found shows that the total US stock market value is currently about $59 trillion, and the annualized GDP of the US is about 29.5 trillion, which means that the Buffett indicator is now at 200% and is saying that the US markets are extremely overvalued. This same website has a historical chart of the Buffett indicator. And right now, it is looking like the Buffett indicator is at an all-time high. And even back during the tech bubble, the Buffett indicator was only at around 150%. So people are saying that right now, the markets are much more expensive than even during the tech bubble. And they're also trying to suggest that the market right now is in an even larger bubble than the tech bubble. However, I think that the Buffett indicator now makes absolutely no sense to use. And here is the reason. 41% of revenue within the S&P 500 companies comes from abroad now. And we can see that this is a trend that has been continuing for the past decade. And over the last few decades, this is a trend that has been continuing. So the issue is that now, US companies receive revenues and profits from all over the world. They no longer rely just on the US economy to grow and produce earnings. US companies earn tons of money internationally now. So looking at just the US GDP does not make a lot of sense to me because these companies are getting 41% of their revenues from GDPs all over the world. And since they're getting revenues and profits from all over the world, I think that we should just look at, the GDPs that they're actually getting their revenues and profits from. Because what ultimately matters is how much profits are these businesses producing. It doesn't matter about what is the US GDP anymore because they're not just getting their profits from the US GDP. So I think that this metric is really, it just doesn't really make a lot of sense to pay attention to anymore. But I have noticed that this metric does pop up quite a bit on social media, and people try to use it as a way to say that people should be selling their stocks or people should be fearful or the market is in a bubble. But when you just think about it logically, and when you think about how the leading companies in the United States have become truly global companies that sell their products all over the world, and globalization has allowed companies to continue selling products all over the world, then it doesn't really make sense to look at the value of the US stock market just relative to the US GDP, because, again, these companies are getting their profits from all over the freaking place now. So I disagree. Buffett is one of my mentors. I respect Buffett highly, but I think that logically this metric does not make a lot of sense to pay attention to. And personally, it's not something that I ever look at in my own investing, or even when I'm trying to analyze the value of the stock market. It's just not even something that I consider because logically it doesn't make sense to consider anymore. And with that being said, let's now move on to the next topic of discussion, which is that NVIDIA's CEO said that quantum computing is closer than we think. So I'm going to play around a 1-minute clip and then we'll quickly discuss it afterwards.
Quantum computing is reaching an inflection point. We've been working with quantum computing companies all over the world in several different ways, but here in Europe, there's a large community. I saw Pascal last night. I saw Barcelona supercomputing last night. It is clear now we're within reach of being able to apply quantum computing, quantum classical computing in areas that can solve some interesting problems in the coming years. This is a really exciting time. And so we've been working with all of the supercomputing centers. It's very clear now that over the next several years, or at least the next generation of supercomputers, every single one of them will have a QPU assigned and QPU connected to GPUs.
In this clip, Jensen is saying that quantum computing is reaching an inflection point. And I think that this is very interesting because quantum computing is a lot like fusion, where people always say that it's a decade away, it's a decade away, it's a decade away. But I actually think that quantum computing is getting closer and closer. And the CEO of NVIDIA, Jensen here, is saying that it is truly getting to that inflection point where within the next few years, we could be using quantum computing to solve issues and do calculations in real world examples and apply quantum computing to the real world. He actually said in this clip that computers that we're even using today can be amplified with quantum computing in the future. And as I said at the beginning of this video, this is causing quantum computing stocks to go absolutely wild. So this ticker right here is QUBT, and this company is literally called Quantum Computing Inc. And we can see that it is up 25.4% on the day after Jensen said this. And we can see that the stock has actually ran roughly it's ran about 27x in the past year. And this is one of the stocks that I actually get asked about quite a bit because the stock price is going up dramatically and people are wondering if the stock is looking attractive. Now, if we just head over to Stock Unlock Insights right here, I'm immediately seeing that the score is 2.51, which is a bad. So let's scroll down and take a look at what is going on with quantum computing here. Well, its profitability score is 1.57. Its operating margin is negative 7,000. Its net margin is negative 12,000. Its free cash flow margin is negative 6,000. Its management score is 2.14. Stock-based compensation as a percentage of revenue is 1,500%, okay? So stock-based compensation is 15 times higher than the amount of revenue that this business is even generating. That is absolutely insane. ROIC is negative 51%, ROCE negative 11%, and just terrible. Now, if we look at growth, revenue did grow by 47% last year. However, gross profits are basically flat, operating income is declining, net income is declining, and operating cash flows are basically flat. So when I take a quick look at this business, it looks incredibly unprofitable and the management looks like they're making away like bandits. Now, in the trailing 12 months, we can also see that this company produced $385,000 in revenue, okay? Stock Unlock, which is the platform that we are using right now to analyze this business, produces more revenue than this business on an annual basis, okay? The platform makes more money than quantum computing does right here. We can see that this business's revenue grew from 30,000 to around 400,000 over the past few years, but still, this is not a lot of revenue that the business is generating. Now, if we also take a look at their operating cash flows, we can see that they lost $17 million in operating profits last year. And just for fun, let's go and take a look at their free cash flows. And the company lost $23 million in free cash flow last year. So this business is very much so losing money, and it's only doing about $400,000 in revenue per year, yet the company has a market valuation of $2.13 billion. This means that its price to sales ratio is 5,537. That is absolute insanity. So I think that what's happening is the hype around quantum computing is causing quantum computing stocks to go absolutely nuts. And this is straight up gambling, in my opinion. This company has basically no revenues. It's losing $23 million per year. It's burning through its cash position, but yet it has a $2 billion market cap, in my opinion, because its company name is literally quantum computing. So whenever there's quantum computing hype or people think that quantum computing is going to be this massive industry, then what I've noticed is these stocks just run wildly. But when you take a look at the underlying fundamentals of the business, they're absolute trash. There's pretty much nothing there. Like if Stock Unlock got a $2 billion valuation today, I would sell my shares and I would be a billionaire tomorrow. That is ridiculous. Like, that's just to put in perspective how expensive this business has become. A 5,000 price to sales ratio. This stock right here makes Palantir look like a steal in the market. So no, I am not interested in quantum computing stocks. And I think that people should just be very careful because, as I said, I've actually been asked about this stock quite a bit over the past month or so, especially with the hype in quantum computing. And the reason that I'm getting asked about this stock, in my opinion, is just because its share price is going up. But you have to understand that in the short term, share prices can run wild and they can get extremely disconnected from the fundamentals of the business. But over the long term, it's the fundamentals that always matter. At some point in the future, this share price will become reconnected with the fundamentals of the business. And if the fundamentals of the business do not grow rapidly from here, then I think that this stock is going to go down in a big way. That's just my speculation. That's my opinion based on everything that I've learned about investing and based on me living through these bubbles and these hype cycles before. This is not the first time I've seen something like this. And usually it doesn't end up well for people who are in it for the long term and buying this stock thinking it's going to continue going up 27x over the next year. So that's a long way for me to say, just be careful, guys. And yeah, just be careful buying stocks just because they're going up. And you really just want to take a look at the fundamentals of the business and make sure that we are investing in fundamentally sound companies at the end of the day, because in my opinion, fundamentals are all that matter. With that being said, let's move on to the next topic of discussion, which is Westinghouse. And Westinghouse is owned by Brookfield Renewable. And there's been some really interesting news coming out around Westinghouse and nuclear. And I want to read you guys an article that I found. So this article says, Westinghouse targets $75 billion of U.S. nuclear expansion after Donald Trump order. Westinghouse is in talks with U.S. officials and industry partners about deploying 10 large nuclear reactors to meet the goals of President Donald Trump's executive orders, which aim to unleash an American atomic energy renaissance. The Pennsylvania-based nuclear developer is one of a handful of Western companies capable of designing and building large reactors, which typically have capacity to generate about 1,000 megawatts of electricity, enough to power more than 500,000 homes. The orders published on May 23rd set targets for quadrupling nuclear energy capacity in the US by 2050, starting work on 10 large reactors by 2030, and accelerating regulatory approvals. They have sparked a rush among developers and utilities to fast-track plans as they seek to tap into billions of dollars of federal incentives expected to be provided by the administration. There is active engagement with the administration, including key points of interface with the Loan Programs Office, recognizing the importance of financing the development of the model. There are 10 large nuclear reactors in the executive order, and we believe that we can do them all with AP1000 reactors. Our customers, the hyperscalers, the tech firms, the suppliers are all coming together to try and figure out exactly how to deploy. Based on estimates from the Department of Energy, building 10 large nuclear reactors in the US could cost $75 billion without accounting for delays or cost overruns. Westinghouse, jointly owned by private equity group Brookfield and uranium miner Cameco, has enjoyed success with its AP1000 reactor, a pressurized water reactor operating at several locations in the US and China. At least a dozen additional plants are either in construction or under contract in Poland, China, Ukraine, and Bulgaria. So President Donald Trump recently announced that he wants to start an American nuclear power renaissance, and Westinghouse is one of the companies that is, well, they're one of the leaders in the nuclear reactor industry, and they are partly owned by Brookfield Renewables and Cameco. It's kind of a joint venture between the two companies. In fact, it's actually Brookfield Renewables that owns the largest portion of Westinghouse. And Westinghouse is now looking like it may win a lot of brand new nuclear reactor contracts in the United States because the United States wants to build out more nuclear energy. I actually did a very, very long video on nuclear energy on my channel in the past. The video absolutely flopped, so I made it private, but I will put a link in the description if you want to check it out. You can still view it, it's just not public. And in that video, I was sharing all of the evidence, all of the data that suggests that nuclear power has to be built out a lot more in the future if we truly want to become a more clean energy society, and if we want to build out more energy in general. Nuclear energy is the cleanest, safest, most powerful energy that we have access to, but the optics around nuclear suck because we have had events like Fukushima and Chernobyl. And when these events happen, it makes the nuclear industry look terrible. And you know, it's obvious why. But nuclear energy has come a long way since then, and it's actually incredibly safe, it's incredibly powerful, and it's incredibly clean. And in my opinion, we should be building nuclear reactors as fast as we possibly can. So I'm happy to see that President Trump, this is one of the things that I agree with him on, is that we need a lot more nuclear and we should be making it happen as quickly as possible. Now, Brookfield Renewables, as I said, BEP, is the company that owns the large position in Westinghouse. So if Westinghouse wins these contracts, then BEP could benefit massively. Now, if you've been watching my channel for some time, then you know that I also made a video near the beginning of 2025 saying that Brookfield Renewables, BEP, was, in my opinion, one of the top dividend stocks in the market. At the time, the stock had an over 7% dividend yield, and if we take a look, its year-to-date returns are now sitting at over 12%. So in 2025 so far, Brookfield Renewables has massively outperformed the S&P 500 while also offering an over 5% dividend yield, and at the beginning of the year, it was offering that 7% dividend yield. I also think that Westinghouse winning all of these contracts and the overall growth of the nuclear industry will benefit BEP and Brookfield Corporation because Brookfield Corporation owns over 300 million shares of BEP, which is valued currently around $7.6 billion. So if BEP benefits, then Brookfield Corporation will also benefit. And that's kind of why I own Brookfield Corporation, is because they're exposed to all of the growth of all of Brookfield's different businesses and their subsidiaries. It's kind of like a more diversified way to get access to all of the growth of all of the Brookfield names. And in general, I think that BN is going to benefit from this. And I think that BN is still, in my opinion, the best long-term growth play because it is the business that is most focused on reinvesting cash flows back into growth. Because as I said, BEP does pay out a large dividend. Even the dividend today is around 6%. So they pay out a lot of the cash flow as a dividend. And as someone who is young and I have lots of time left to invest in my life, I would prefer to own a business that's taking its cash flows and not paying out a dividend, and instead taking the cash flows and reinvesting it back into the business and growth. And that's what Brookfield Corporation does. That's why Brookfield Corporation is the largest position in my portfolio. It's why I don't own BEP directly, and I don't own BIP or any of the other affiliates and subsidiaries directly, because those companies are more focused on paying out dividends, and I just want more growth and I want more reinvestment back into the business. But in general, I do personally think that BEP is still an attractive stock, especially for the income. It's just not my personal goal, and that's why I don't own BEP shares in my portfolio anymore. But I thought that this was a cool update for Brookfield, and I'm definitely still bullish on the overall Brookfield family. All right, let's now move on and talk about Airbnb, because on May 13th, they announced their huge summer release, and they said, now you can Airbnb more than an Airbnb. Now, for a little bit of some backstory, Airbnb's CEO, Brian Chesky, has been hyping up this new summer launch for, I think, over a year now. He was really making it clear, like, hey, you guys need to be tuning into our major summer launch. Airbnb is becoming more than the Airbnb that you know that it is today. We're expanding the business. We're going to create many new verticals. And he really, really hyped this up, okay? So he was really hyping this up. And the reason that I was paying attention is because I saw Airbnb as a stock that I may want to own one day. But after this release, I would say that I've become more distanced from wanting to own the stock than wanting to own it. So this is what they announced. They said, introducing Airbnb services, Airbnb experiences, and an all-new Airbnb app. Airbnb services, incredible services to make your stay more special. Airbnb experiences, explore a city with the locals who know it best, and the all-new Airbnb app. In their press release, they also gave us some examples of Airbnb services, like chefs, fully customizable in-home meals from professional chefs, photography, massage, spa treatments, personal training, hair, makeup, nails, prepared meals, and catering. So these are services that are now offered and you can book on the Airbnb app, okay? So if I wanted to, I could go and book a haircut through Airbnb's platform. That's kind of the idea here. Then they have their all new Airbnb app and they show that they have experiences that are apparently new. Now, if you've been using the Airbnb app for some time, then you know that experiences is not actually new. They've had experiences for a very long time. I've traveled the world. I was in Asia for 3 months last year or a couple of years ago. And I did look at what type of experiences were on the Airbnb app while I was on my travels to see if there was anything interesting. And I just, for some reason, I never felt compelled to want to book an experience on Airbnb. What I found myself doing was simply heading over to Google to figure out what we wanted to do that day. And I personally just don't think that this is going to be very successful because as we saw, you can now book a haircut on Airbnb. Here's the issue. If I want to book a haircut, my natural tendency is to go over to Google search and type in barbershops around me. Then what I do is I look at the reviews on the barbershop. And I know that, Google is the place that people go. And I know that Google reviews, at least in my experience, are pretty dang reliable. Like, for example, if I'm going to a restaurant and I see that it has 1,000 3-star reviews, I'm not going to that restaurant. I don't even want to look anymore. That's a note for me. But if I see that the restaurant or the barber has 500 4.5 star reviews, then I know that that's probably a pretty good place to go and the service is probably pretty damn good. So I rely on Google reviews a lot when I'm doing my research into where I want to get a haircut, where I want to go out to eat, where I want to get a massage. And that's kind of like the network moat that Google has. And this is also another point. I know that every single barbershop in my city or in the area that I'm in is going to be on Google. If you want to be a successful company today, you need to be on Google. That's where people go to search. So I know that when I go to Google and I'm looking for a haircut, I have 100% of the options. Every option is there, okay? Now, when I go to Airbnb, there may be one barber. There may be two barbers. There's also not really a lot of reviews. So if I went to Airbnb, what I would be doing is I would be limiting my search. I would be limiting the amount of potential barbershops that I can view. And therefore I know that I would be missing out on other barbershops that may be better. So if I were to use Airbnb for services, I would go there, I would look at what they have, and then I would go over to Google and I would Google search barbershops to try and get a wider search with more reviews. And ultimately what that leads me to believe is that Airbnb through services is now trying to compete with Google. I don't think this is a good idea. I think they're going to lose, and I don't think that this is going to materially impact Airbnb's business in any way. And I would be surprised if these new launches, increased Airbnb's revenue by even 1% this year. I don't think that this is going to do virtually anything for their business. And the reason that this is such a turnoff for me is because, again, Airbnb's CEO and the business was hyping this up a lot before this announcement. And then when they did this announcement, I was extremely, extremely underwhelmed. Like, to me, this looks like an experiences rebrand. I don't really see them adding that much new to the platform and to the business. They're just kind of making it, they're making the experiences part of the business more upfront and more in your face. Because when you go to the app now, you see experiences and services right at the top, right in your face. So I think that they're just trying to promote this side of their business more, but I'm not bullish on it working out at all. Experiences has always been part of the business. I've always known about it as a user. I've never used it. I've never really wanted to use it. I've never found it that valuable or like there's many unique experiences. And now that they're adding services, I think they're trying to compete with Google search, which I just don't think is going to work. So I think that the management of Airbnb is kind of making the wrong moves, in my opinion. I think that they're focusing a lot of attention, a lot of marketing, and a lot of dollars on things that are just not going to work. And that doesn't give me more faith in the business. That gives me less faith in the business, which overall leads me further away from wanting to invest in the company. So I personally am not really interested in Airbnb stock. It's trading for about 19 times cash flows today, which arguably is not that expensive, but I just don't agree with the direction the company is going in. And as a result, I'm not really interested in owning the stock. That's my take on Airbnb today. That's my take on their new big summer launch, which is really just an experiences rebrand. And if anything, I'm becoming more bearish on the company over time, not more bullish. So now let's move on to the last topic that I want to discuss in this video, which is the stock that I sold. And the stock that I sold is Equitable Bank. And the reason that I want to talk about this one is because this is a stock that I've talked about previously on my channel. I've actually moved away from talking about a lot of Canadian stocks on my channel and a lot of international stocks on my channel, simply because whenever I do, my viewership goes down. That's just the way it is. People just don't seem to care as much about these types of businesses. And it was actually harming my channel to talk about these stocks. But I did make it very clear on my channel that I did own Equitable Bank. I also got a lot of comments asking me to do an update on Equitable Bank. And yeah, after the last earnings report, I did sell out of my position entirely. I don't own the stock anymore. I did come out with an over 30% profit on my overall position because I was buying EQB shares aggressively here in this dip in 2022, and the stock still is up roughly 90% from that area. I was also buying shares in these dips here. That's why my average increased, because I'm very happy to average up on positions. But I did end up selling my position after the most recent earnings report. And I do have some screenshots here to explain why. I did do a full in-depth video for my Patreon community, fully explaining why I sold, going through the earnings, and it was probably a 20-minute video just on my on my Equitable Bank sell. So if you want access to all of my buys and sells, my deep dives, and just a lot more content from me, then consider checking out my Patreon. It's only $15 per month. I also do monthly portfolio updates over there where you see everything I own and I discuss every single stock that I own at length. So yeah, it's $15 a month. My Patreon community has been absolutely loving it. I'm getting great feedback over there. And honestly, for $15, I think that it is a very good value to price. If you want to take the value to price, very good deal over there. But anyways, let's go back to 2024. All right. So this was actually in 2023 when Equitable Bank put out their 2024 guidance. And here they said that they were expecting diluted earnings per share for 2024 to be roughly $12. Now, when I saw this, I was like, wow, that's awesome. Equitable Bank is projecting to grow massively in 2024, so I'm going to continue buying the stock, okay? So this was the fourth quarter of 2023. They projected $12 in earnings per share. Now, if we take a look at the results for 2024, we can see that their earnings per share came in at $11 on an adjusted basis and $10 on a GAAP basis. So they massively missed their guidance for 2024. Now, if you've been following the story of Equitable Bank, this is because they acquired a trucking lending portfolio, basically a trucking lending portfolio in 2024 through their acquisition of Concentra Bank. And the trucking industry went through a really large downturn, which caused the company to have more losses than they were expecting. I am okay to give a company a write-off. I'm okay to give management a write-off because I did think that these losses made sense. I think that they did kind of come out of nowhere. I did think that maybe management couldn't see them coming. So I'm willing to give a company a write-off if I believe it's a one-time thing. And also, I'm not going to go through all the screenshots and everything, but in the fourth quarter 2024 conference call, the CEO of Equitable Bank made it very clear that they did not want a repeat of 2024. 2024 was a one-off. It's never going to happen again. The company is going to do everything that they can to make sure that 2024 is never repeated. I was like, sick. Okay, that's what I want to hear. And then in their Q4 2024 investor presentation, they also put out their medium-term guidance and their guidance for 2025, where they said that earnings per share was going to grow by 12 to 15%. This was basically the company saying, hey, we're going to get back on track in 2025. 2024 is behind us. We went through it. It was a bad year, but now we're moving on. Everything should be fine from now on. So I said, sick. Okay, I'm going to give them a pass on that. Let's continue to see how things play out. Everything should be fine. Then we head over to the second quarter of 2025 now, okay? So now we're on the second quarter of this year. And we see that adjusted diluted earnings per share declined by 22% quarter over quarter and 17% year over year. Revenue is down year over year and down quarter over quarter. Adjusted pre-provision pre-tax income is down 8% year over year, 6% quarter over quarter. Adjusted net income is down 15% year over year, 19% quarter over quarter. Their customers did grow by 23% year over year, but we can see that the company's earnings and revenue is declining in a big way on a year over year basis. So this is a company that said, hey, 2024 was a one-off. It's not going to happen again. Now we're in the second quarter of 2025 and earnings dropped by 20% year over year. So the company is not just having another 2024. It's looking like so far 2025 is actually even worse. And this was enough for me to say, you know what? I've given you guys enough time. Things don't really look like they're getting any better, and it's time for me to sell my position. And let me zoom out and show you a little bit more data here, okay? So in the most recent quarter, Equitable Bank did $2.21 in earnings per share. And this is now the earnings per share level that the company was producing all the way back in 2020 in the third quarter. So the company's earnings per share is now basically flat for 5 years. They've lost about 5 years of growth. And I think that this is not really looking like a growth investment anymore. If we look at their revenue, we can see that revenue is all the way back to the second quarter of 2023 levels. And also, again, I'm not going to go through all the screenshots, but Equitable Bank's loss ratios are increasing. So once again, they said that they didn't want a repeat of 2024, but so far in 2025, the company's loss ratios are going up. So it looks like things are actually getting worse in this year. This kind of suggests to me that management either just didn't know that this was coming, or they overshot guidance and they tried to just give a more rosy outlook than they saw coming. Both are bad. Now, additionally, I believe that Equitable Bank is getting their moat attacked by Wealthsimple. If you take a look at Equitable Bank's customer count, we saw that it was 23% year-over-year growth. However, the company's deposits, their customer deposits, haven't been growing at the same rate, which means that their deposit per customer is consistently declining. Now, at the same time, there's data that suggests that Wealthsimple is growing customers faster and their deposits are growing on a per customer basis. So what this means for a bank, okay? If your deposit per customer is going down, then it kind of suggests that people are moving money out of your bank. What you want is your deposits per customer to grow because it means that they're interacting with your bank more and they're putting more money into your bank. Wealthsimple is not a bank, I know this, but they do let people deposit money and they are offering a lot of banking services. And on that note, EQB has been promoting their business account for, I think, 2 years now, and it's still not launched. I believe that in 2024, they also said that it would be launched and they would start reporting their business account KPI as a KPI for investors. It's still not launched. It's been like 2 years. It's still not launched. Like, how difficult is it to build a freaking business savings account? Like, come on, guys. At the same time, over the past couple of years, Wealthsimple has launched dozens and dozens of products, and they've completely, their pace of innovation is so much faster than EQB. What this has led me to believe is that EQB is the second tier online bank now. Wealthsimple is clearly number one. I've talked to a lot of people on my Patreon. I've talked to a lot of people in my personal life. Everyone I know has a Wealthsimple account. Almost no one has an EQB account. And I think the trend is widening. So to summarize, I think that EQB has lost their market position. I think management has actually done a really bad job. They've missed guidance consistently. I've lost my faith in this business. I've lost my faith in management. And I think that they're now the second tier company. Their pace of innovation is just really slow. I don't know what's going on over there, but Wealthsimple is kicking their butt, and I think that trend is going to continue. So I have sold my EQB shares. I'm happy that I got out with a profit on this one. I did actually make a substantial amount of money on this one, but it just felt like time to let go because I do truly believe that the fundamentals of this business has deteriorated, and that's just where I sit with it. So I did sell my EQB stake and I did put the money into a new investment. As I have said, I have been exploring the international markets a lot, and I have purchased a pretty large position in an international stock with my EQB proceeds. And as I said earlier, if you do want to get access to my portfolios, everything I own, all my buys and sells, and dozens of deep dives and more Patreon content from me, then go and check out my Patreon. As I said, it's only $15 per month, but people have been absolutely loving it, especially now that I have been exploring international stocks. Also, the best brokerage to get access to the international markets is Interactive Brokers. I did a lot of research. Hands down, it's the best. They have the lowest fees and you get access to so many stocks across the globe. So if you're interested in checking out Interactive Brokers, then I do have an affiliate link in the description as well. And I would recommend just checking them out. You don't have to sign up for an account, but go and check out their fees and go and check out all of the stocks that you get access to with Interactive Brokers. Again, I do have a link in the description if you want to check them out. But with that being said, that is going to wrap up the video for today, everyone. If you did enjoy the video, as always, please remember to leave a like on it. And if you're new here, then please consider subscribing to my channel. But my voice is hurting. This was a long video. I truly do appreciate you guys checking out my video today, giving me your time, and I hope to see you all again in my next one.